Okay, so last time. Uh, so in the last 2 weeks, mostly I was talking about how can we fund the company from equity-like instruments, but today I would like to talk about debt and debt-like uh, funding. And practically, if we are looking on the profit and loss statement, the paid interests are not so significant in my case because practically I was lucky and this this setup of the simulation, so this sample doesn't require so much depth. But what happens if we need it? So because at the first year it's highly it's practically sheer luck, because after that we can see that yes, the company starts to make cash, but here we are surviving from 1 million euros. So if we need some kind of safeguard cushion, then we can still say that okay, let's increase the debt by 100, because practically it's still really cheap to fund ourselves. So okay, this data was downloaded in February maybe, or yeah, in February when we updated this one. And yeah, so under 8% of inflation we have 3.6, sometimes 3.7% of interest rate. So practically we have still negative real interest rate. So it's really cheap to finance everything. And so that's why we can see that even if I'm increasing the debt by 100 million euros just to safeguard us against any kind of sudden liquidity shocks, still we can say that this is really cheap. So we have to pay 4 million euros annually, which is really small compared to the rest of the, or compared to the profit. Okay, obviously if I'm increasing the debt by this one, then our cash reserve will increase as well. So because we are not using up this money, just I'm creating a cash buffer. So practically we are just sitting on it, and now still we have a profit for the first year. So yeah, it's not that great, but not terrible. Yeah. However, we should assess and evaluate the situation, because maybe in the future, so practically this is absolutely extraordinary. So this is not supposed to happen. Uh, if we would have this situation or have this suggestion that we can operate not just a country but a whole world economy under negative negative real interest rates. And if you remember, 5 years ago we had also negative nominal interest rates as well. People would laugh at us. So this is absolutely not normal phenomenon. So we should check the situation, what would happen if things would behave in a nice way. So that's why we have this funding worksheet with us. And so let's start with some colorings. So mostly, what do we need to cover when we have to finance, or when we have to issue debt? So obviously a significant part will be related to inflation. So a core idea of finance is that okay, investors cannot be dumb enough to find anything if they are not compensated against inflation, except during the last several years. But still we can see that if we are checking the yield curve, so how long investors are providing funding for governments, and right now for the French government, for different time periods, so from 1 month until 25 years or even 50 years, still we can say that yeah, it's around 3%. But when I created the case study a year ago, it was really close to zero. So steadily interest rates and yields are increasing. Just at the same time we can see that yeah, but inflation is 8% in the Eurozone right now. So it's still, it's not enough, and we can say it's negligible. Okay, in the long run we can say that yeah, long run inflation expectations are usually around, if the monetary policy is credible enough, then they are just above the long-term expected 2%, because European Central Bank has this medium-run inflation target of 2% in a year. So we could expect, if we are planning anything, then we can say that okay, but after 3 years, short-term inflation shocks are disappearing from the market, and after that it will converge to 3%. So if we are checking the longer time periods like 10-year yields, we can say that yeah, but if it's above 2%, then still we can have a chance to have some kind of real interest revenue. But if you are checking the 1 year, 3%, this is not healthy at all. And also, if we are checking the classical financial theory, then we can say that okay, but above inflation, still we need some kind of sovereign premium. So in this case, sovereign premium, usually the benchmark can be a country with a really good or excellent credit rating. So where the credit rating is AAA or something like this. So usually in euros we can say German government bond yields can be at the minimum level, and so it can be German, or in the case of US dollar it can be US public debt. So in this case it's quite obvious that yeah.
Sorry, can you
Yes.
explain a little bit about sovereign premium?
Yeah. So in this case, if we are taking any country, so let's say right now France, then to sell French government bonds on the market, you have to provide some kind of premium above the lowest benchmark. So right now, let's say German, because if we are checking German credit rating, Google will give us something, yeah, from Moody's. They are saying is AAA, so they are excellent. If we are checking the French one, then we can see this is just AA. So this is not that great. It's still excellent, so it's really good, just it's not perfect. So that's why this kind of risk must be compensated somehow. Or if we are not just leaving at the finance or the French example, so Hungary is somewhere in category B, is still investment rated, but it's much more riskier. So in this case, investors will require higher and higher premium, but still against the government bonds. So okay, so local government bonds. You have to provide this, otherwise if you are not providing this kind of premium, so if the interest rates are lower, then the currencies start to depreciate, or even we can see that portfolio investments are moving out from the economy, and usually foreign investors can have 30% of the overall sovereign financing. So in the government bond market, they have sometimes 30% of shares, sometimes it's just 5% of shares. So it depends from country to country. But external funding or even domestic investors are saying that okay, I will not keep my money in domestic assets, so let's move and invest into foreign assets if they don't get these sovereign premiums. And of course, this sovereign premium is highly related to not just the risk of non-payment, but also it depends on the market sentiment. So also we can see psychology is there that if the market investors or any kind of investors are afraid that oh my god, something is happening with this country, then similar countries sovereign premium starts to increase as well. So when there were issues with the Greek government bond yields in 2015, also we were able to see that other countries' government bond yields started to increase as well, not just the Greek one. So that's why sovereign premium is a flexible thing, and we can see that many things can affect this one. But also we should add another thing, and if we are financing a company, then also there is the risk premium. Because let's use the green color. So because we have to compensate also the probability of the corporate default as well. So if you are providing it to a private entity, like for example I get a loan or a company will get the loan, then still we have to see that okay, but what is the probability of going down here, because obviously private entities, companies, households are much more riskier than the government, so they are always assumed to be riskier. In our case, we have this really sophisticated approach. Practically we have two approaches in the case study. So that is the old school Altman Z-score. Unfortunately, Altman Z-score is not providing us any probability, and it was published in the late 60s, so I wasn't like it so much, but people are still using it. So yeah, if I'm scrolling sideways, we can find here many things. So practically Altman Z, we can calculate it easily because we just have to take the relevant informations from the balance sheet or sometimes profit and loss statement, and after that we just have to multiply them with these numbers, and from year to year. So this is all for the 5 years ahead what we had this in this scope, and after that, what are these numbers? Yeah, this is just the multiplication. Okay, so these are just the x numbers, and after that these are under the multiplication, and at the end of the day we have this Altman value, and that's why I also doesn't like it, because this thing is operating between thresholds. So if you are above the green line, then it has a really low probability. So under, if I remember well, there is just 10% of probability that the company is going to default within the next 2 years. If you are under the red line, then it's 90% probable that the company is going to default within the next 2 years. Right now the company is under this, so this is my refined works. So yeah,
It's gonna default in.
so it's supposed to be improved, but it doesn't improve at all. So this should be so in between there is the gray zone. In this case the model is absolutely not able to decide that what is happening here. Just again, so this model was calibrated in the 60s, if I remember well, it was 1968, so it was a really long time ago. It was calibrated on US companies in all from many different sectors. On the other hand, it's still really popular today because it's easy to calculate, so we just have to sit down. And also, last time when I checked, there were at least 3,000 academic journal papers which tested this model in different countries, in different sectors, and so people are still using it. But it's absolutely outdated and I don't like it, but still I have to talk about it because it's relevant. What is much better is the also-no score. So this one was also published in the 80s. If I remember right, it was exactly 1980 when Ozone had this article written. But why it's really good, that this one is providing an exact probability of default. So it's estimating and practically we checked this Ozono score 2 years ago in a paper, and it's still valid. So we were checking Hungarian companies and Hungarian companies' probability of default. So we were checking what are so can we use this kind of coefficients, so dividing the total liabilities with total assets, working capital with total assets, and so on. And practically, these are the coefficients where we should have to multiply them. And at the end of the day, it was working. So this is quite a robust model. And also, here we can have exact probability of defaults, which is good, really good for us, because we can see some kind of improvement. Okay, it's not that great, but at least it's not 100% or close to 100%. So if you are checking the original company, my bankruptcy ratio was even more terrible in case of Altman, and also it was increasing dramatically year by year. So this is quite an improvement, what we can see here, and also it's really easy to estimate. So that's why, okay, in the case of working capital, we have to estimate it. So if you don't have a cash flow report, then we should assume it otherwise by taking the difference between current liabilities and current asset, which is not the perfect way. But okay, so it's a good assumption, but still it's easy. Nowadays people are also trying to use neural networks where they are just giving surviving and non-surviving companies data to the model, and after that just the model gives you an estimation that if you are adding the company what you desire to analyze, then it gives you also some kind of probability. Just in this case, the whole method is a black box. So you have no idea which variables are relevant and which variables are not relevant. At least here we can say that, okay, we have to download this kind of data, and after that we can see that what is their contribution here and there. So yeah, I can understand why it's popular to have neural networks. Just from teaching point of view, this is good enough. So okay, so we have to compensate this kind of risk, and also at the end of the day we have a last premium. Let's use orange, and this is the term premium. So in this case the length, obviously the longevity of the loan. So we should compensate our investors if they are providing us long-term funding. So that's why the yield curve is supposed to have a positive steepness, which is absolutely not there, but in theory we should see something like this. So let's look for. Okay, Canada will be, I think, even more flatter. Yes, because this one is a safe haven asset. So let's see something which is not a safe haven. Hungary. Oh, yeah, because right now it's completely reflecting also on the high inflation for a year, and after that it's just converging down to 8%. So after 7 years we can see that it's going down, while at the same time in Hungary inflation target is 3%. So it provides 5% margin above this. Okay, let's go back to France because we need data from them. So, if we would like to model the behavior of the long-term funding conditions, then we can say that, okay, let's look 5 years ahead, and still we can say that, okay, what is the expectations about the inflation, what is the expectation about the sovereign premium, what is expected about the risk premium, and after that, in the case of term premium, it will be hard to see, but the rest can be at least modeled somehow. So first of all, let's check inflation. Oh. Oh, yeah. Cookies. Usually, yes. So okay, I'm always. It always takes a lot of time for me to find this one, but right now I was able to do this. So, so usually central banks have this forecast when they are providing us different scenarios. So this is the optimistic scenario, this is the pessimistic scenario. So we can see that we can fluctuate back and forth. So practically still for 2023 they are expecting 10% of inflation. So we can say, okay, it's 10%. And after that, a year later, we can see that this is supposed to go down at least around 3%. Now practically also they are providing different projections. So this is where we can see that in December of 2022 they were expecting a longer die out of this inflation shock. Now they are expecting a steeper recovery from this inflation shock, but still we can see that we can expect 3% of inflation for the second year. For the third year we can say that it's the same, so let's not complicate it. And after that they are expecting to reach. Oops. The problem of this model is that sooner or later this inflation shock will be removed, but still we are in a state when so this inflation shock was coming from many different reasons. So one reason was the disturbances in the supply chains during COVID and after COVID recovery. Also there was the Ukrainian war, which created also huge shocks in the resource markets. So or if we would analyze also United Kingdom, there would be also the Brexit shock. So there are so many different kind of shocks right now which are imbalancing aggregated demand and supply, and also from exogenous. Or also in case of Europe, last year there was an enormous drought So practically, also in Szeged there were no rain for 3 months, and it created also a huge price shock for agricultural products. So we can find it as well. So this is also an exogenous shock, and as a central bank, it's really hard to decide that which of these shocks are short term and which of these shocks are long term, and that's why this kind of forecasts are based on really sophisticated macro modeling, so we are not making it up. But on the other hand, if they are not able to decide that which thing will be long term or which changes parameters on systemic level, then it can also create wishful thinking that, oh, it will die out soon and we don't have to do anything with that. Because I remember that when I was teaching similar things in 2021, I had already issues in the it was in the autumn semester of 2021 that inflation is increasing and they are doing nothing at all because they were saying that, oh, this is just a short-term shock. And after that, short-term shocks started to accumulate more and more, and yeah. So still we are expecting that now there is empirical evidence in the US or in the Eurozone that inflation is decreasing a bit. Just this is not enough bit. Okay, but right now this is what we have as inflation expectations. Then the next thing, in terms of funding costs, so let's find Germany. Where are you, Germany? Yeah, okay, it was in front of my eyes. Yeah. Yeah, so we can see here, yeah, this is a nice curvy thing, but on the other hand, the scale is between 2.2 and 2.9, so this is practically a flat line. Just they were increasing the scale here, and if you are checking the zero curve, we need to use the zero curve only because in this case all the other components are removed, so everything is converted to yields, so it doesn't have any kind of options or already other biases. So we can see here that for 1 year, 2 year, 3 year, 4 year, 5 years. I have to change the decimal points to decimal commas, and also I should add percentage marks. So right now these are German bond yields, and obviously if you are checking the French ones, we will see there will be not so many differences, hopefully. But if we are so once we are setting the interest rate, we can after that model that what happens if we start to increase sovereign premium. So we can run a different sensitivity analysis strategies. So right now we can say that, okay, the premium is this minus that one, but what happens if it would be 1%, what happens if it would be 2%, and after that we can see that how not just sovereign premium will react on this, but also corporate default related things will react on this. So next, let's see corporate bond yields. Is there any kind of premium here? So fixed income bonds, corporate bonds, and France. And curves. And obviously we don't care about AAA rated companies, so let's see triple B rated companies, because they are the most riskiest. And again, we should download the we did it already several weeks ago. Just in this case, at least we have actual data. Yeah. What we can see in terms of risk premium, that this minus the country's sovereign premium. So it's, at least we can see that companies are still assumed to be riskier than the government. So this is this is working. And after that, in case of term premium, yeah, our tools are not so sophisticated, unfortunately. So we can say that, okay, if we have to make a difference between this asset and this asset, and I have to fix this one, at least it's positive. So we can see that if the debt is longer and longer, then we have to pay higher interest, but right now that's all. But after that, we can use this for modeling purpose. So we can say that, okay, this is the current situation, 23. And then let's check the worst case scenario. So what can possibly go wrong? So what can be the highest level of sovereign premium? In this case, it's easier to download data. So we already get error messages while we are not loading in anything. So yeah. Okay, so we have to download the French. It has some bugs. Okay, so now we have the French, and also the German. I'm just choosing, okay, it's not precise, so I should use not the 10-year but the 1 year, because in this case I'm comparing similar things together. And French 2-year government bond, German 2-year government bond, French 3-year. I don't want to check all the possibilities, just some of them. Okay, and after that, what do we need here is French country BBB rated. Okay. This one. No, it says error, and it doesn't need V or daily data. I think quarterly will be completely enough. Yes, and we have data since 2000, or please max this out. So we have data since 1999, so at least we can find some minimums or maximums. Just still I have to find the right credit curve. Okay, now it's perfect. So we can see that, yeah, sometimes they have to provide premiums, which is good. Do we have 2-year points? I cannot see the 2-year point, but maybe it's there. So let's download this one. Okay, so we have data since 1994, and that's why we can have the premiums. So this number minus this number, and let's give a color, because in this case we can see that what we are doing here. Yep. And after that, we just have to see that what is the minimum. Of this one. And what was the maximum also. So, in this case, yeah, this one is term premium, because we are taking the difference between the 2 years. Still, we should see the risk premium compared to the government bond. It's the first year minus the first year, obviously it's not working, and risk premium 1 and risk premium 2. So second year minus the second year. And we're just scrolling down. Because of missing value it has error messages, but I will delete this one. And after that we can see that what was the lowest and what was the highest. Oops. I'll just have to save it. And in this case now we can calibrate the model. We can see that okay, what can be assumed to be the worst case scenario, because practically this is the worst case scenario for French companies, so even they can have 2% of risk premium, not just, I don't know what is the current state. I will close this one. Okay, so first of all, sovereign premium. And let's just focus on the worst case, because the current situation is still really optimistic. So let's see that it can be 0.9%, it can be 0.6%, 0.8%. So let's look for the worst number here. So let's say that we always providing a 0.9% premium. So because this is highly supported by the data. Okay, there is this lower level, but is this an artifact or not? Let's not care about this. So the other two numbers are saying that it can be 0.9. So if we are modifying the equation, then now we can see that this will be higher. And also, in case of risk premium, we can see that it can be somewhere between 1.42. So let's use 2, because this is the higher number. So 2%. So now we have to take this number plus this one, and in case of term premium, yeah, 0.05%. Okay, so maybe I was lazy in this case to download, but so the zero yield in this case should be, okay, so it's 0%, because so at the end of the day the yield, the highest level of yield should be this thing. And also we can stress this, that what is happening if the inflation is not going down. So because after this inflation is still not added, because I was just saying that okay, we have this kind of risk premium, but the underlying scenario was not changing at all completely. So what was the highest value in case of German government bond yields? It's 5%. So still we can say that, yeah, but if so we have two issues here. We can assume that sooner or later long-term bond yields, at least in the premium segment, must give at least or compensate against inflation. So this is I think the most conservative assumption. So in this case still we can say that, okay, you should compensate inflation. Nothing more, nothing less, but in this case we can see that if we are going against the best case scenario, then this is, I think. So if we are checking that all the worst things are happening in case of sovereign premium, in the case of risk premium, in the case of term premium, and also we have an inflationary shock, then this is what's supposed to happen in the worst of the cases. So now we can save this one, and I will create an alternate worst case scenario here, because we should check this. So how the company is reacting on. Not linking it, it's just referring. And on investment side, still invest. We can invest our cash reserves at least under these terms. Does it have an influence on the probability of default? So 30%, 50%. I think it's still quite the same. Altmanzi is also not reacting. So let's check valuation. So in the case of original, it's 5,000 for 6,600. Okay, it doesn't have such a dramatic influence. So again, that's why it's really important. So if we are able to manage or maintain a healthy state in the company and in its profit making progress, then we can see that, okay, numbers are changing because interest rates are changing. So now still the profitability is so robust that practically it doesn't matter. So until the company is healthy, it doesn't matter that what is the underlying interest rate for funding. If the company is stretched out, if liquidity is a scarce thing for them, and if the profit margin is really narrow, so the company is a price taker, not a price maker, so they are not in a monopolistic, not in an oligopolistic state, but they are operating in a competitive market, then they can have issues. But if you are in an oligopolistic state, like what we can see here in the case of Ariane Space, with all the government support, with all the other issues, and strong background with the parent companies like Airbus and Safran, we can say for them it doesn't matter that what is the interest rate here. So they are happy with higher profits, or they are happy with lower profits. So for them what matters a lot that we have to change the basic or the core of the cash generating procedure. So that's why I doesn't like personally when people are saying that, oh, the economy would grow faster if we would have lower interest rates. Yes, but lower interest rate means that projects with poorer financial performance will be also accepted, because they can be profitable if we are just reducing the interest rates. But at the end of the day, if any kind of external shock is coming, then these projects or companies will go down at first, and after that we can say that, oh my god, there is a recession, and no, we reuse the useless companies. So yeah.